keep him in our thoughts. But Jim and I go back over 40 years. We went to college together. Jim is now president of the United Bank and Trust. It is the second largest ag lender in the state of Kansas, right behind Farm Credit. And Jim and I have done lots and lots of work over the years together. We're working with farm families. And I'll let Jim tell you a little more about their bank and where their branches are and what their involvement is in production agriculture. Jim's here at the last minute, so he's not here with a prepared PowerPoint or anything, and I think that's fine. Because what we're looking for is let's just have a good discussion and ask lots of questions and give Jim some insights of what you're thinking about and what you're seeing, and he'll give us his insights too. So Jim, thank you for being here. We appreciate it.
Dwayne, thank you very much. I'm not used to speaking in front of a group here. I usually on one-on-one, and so you'll have to forgive me for maybe my stuttering and that sort of thing. As Dwayne did say, we do go back a long ways. There's probably some stories we could tell, but we probably best not get into that today. Going to college together, and I think I might have even helped set him up with his first date or something like that. I don't remember it. I think he's currently married to that young lady right now. So, but anyway, my name's Jim Pachta with United Bank and Trust. We're a bank in northeast Kansas with locations in 7 counties. Our major focus, of course, is ag lending. We do some commercial lending as well, but primarily ag lending. I've been in the lending business for going on 36 years. I actually live in the little town of Lynn, Kansas, and that's where the bank that I work out of. Our bank is a $500 million bank, and again, like I said, our main focus is ag lending. We have 4 senior managers. I'm one of the senior managers. John back here in the corner, maybe you met John, or John used to work for us, and we hated to see him go, but I told him a little while ago that probably going into extension was better than staying with the banking business. And as things are changing here, and that's kind of what this is a little bit about today. You know, agriculture has come through a really good time period when it was pretty hard to make a mistake. Even though there was a lot of mistakes made, they just didn't show up. And as we're seeing the markets turn around, kind of come back down, the cattle industry's not looking real positive right now. All these factors are going to lead into situations where we're going to have farm customers that are going to need more help to get through the situation. In fact, there's going to be some customers, just like there was in the 80s, that didn't or won't make it through. Dwayne and I go back to the 80s, and that's kind of where the Farm Analyst program actually kind of got started. Shortly after I started the banking career, the 80s hit, and for those of you that remember the 80s, there were some pretty tough times and some pretty tough situations. I told myself that if we ever got into that situation again, I was going to get out of the banking business. I don't think we will see it that bad this time, but we are going to see a situation where we're going to have farmers that aren't going to get through this situation. In fact, I've probably got 2 or 3 in my bank that aren't going to make it. You know, I was visiting with one of the other senior lenders this morning, telling him that I was going to be coming down here. And we stress test all of our ag portfolios, customers, mainly for interest rate changes and changes in commodity prices, livestock prices. And when we do that, it gives us an idea of what this customer might look like if we see a 20% drop in commodity prices, livestock prices, if we see a 1 or 2% increase in interest rates against their borrowing. We estimate that probably 10 to 12% of our customers will need some sort of assistance to get through the situation if we see those things happen. So, you know, that being said, I think that this Farm Analyst program, and Dwayne was telling me that we're going to put on more farm analysts in the state, which I think there's going to be a definite need for that. I've actually used the farm analyst program I was probably one of the first banks to use it. I was not with United Bank and Trust at that time, although I was in Lynn, Kansas. I actually went through six bank changes in those years, and that's the banking industry's changed just about as much as the agricultural industry's changed. The farm analyst program, and Dwayne I have to credit Dwayne for saving some customers that we had in our bank. And as you folks are training to start doing that, you will have the opportunity to do that as well and help some of these customers get through some of these stressful times. Today I think Dwayne probably still sees a few of these clientele that he started out with. And most of those people, if you build a relationship with those people, they will definitely remember that. And a lot of those folks still call. I don't know, you were actually the only point man, I think, for a little while with the farm analyst program. And it got to the point where there was enough need that Dwayne couldn't see all of those people on his own. But some of those original people were with my bank and customers of my bank. They still want to see Dwayne because they build that kind of relationship. And you will have the opportunity to do that as well. And the one thing Dwayne and I were just visiting about here a little while ago, when you have the opportunity to meet with some of these farm clients, they're going to be a lot more receptive to visiting with you than they are their community banker, because they don't feel there's kind of a, I don't want to say a threat, that's not the word to use, and I said maybe John can throw a comment in here since he was in the banking business for a while. But when a customer starts to get into a little bit of a stress situation, they don't always work with you the way that you would like them to. And when someone from the outside that is a disinterested third party, so to speak, they will listen to that individual much better than they would the banker. And it's not that the banks don't have the tools and the capability to do some of the same things that you do with the farm analyst program, because they're out there and we do. But we just find when we bring in a third party that it just works so much better working with these customers. And if you may not tell them the same thing that we tell them, but it may come out after they see it on paper. And if they see it from you, it's going to look different than if they see it from us. I guess, Dwayne, I'm going to, from there, I don't know what you would like me to say. The Farm Analyst Program is a very good program. There's no question about it. And there's definitely a need for it. We're going to, we're definitely going to have more and more customers, like I said, that are going to call on something like that. I mean, there's other programs out there. I mean, there's actually a bank not too far from us that's promoting a program very similar to this. But the sheer fact of the matter is, as I told you a few minutes ago, for me to use that program doesn't really benefit me or the client, because that client or that customer of the bank just will not be as open with me as they would with one of you if you go out to meet with them. So I guess I'm going to let you ask questions a little bit about the program, about what it's done for our bank, that sort of thing.
Jim, talk about the involvement of FSA with your bank and what it means and what it does for your division.
Okay. FSA has been a fantastic partner for ag banks across the state. I really have to commend the state office and the regional and the local FSA offices. We've got some excellent FSA officers out there that are helping the bank. In the 80s, FSA actually came out with a guaranteed loan program. We were I would probably put the first FSA guarantee together in the Washington office in Washington County. Those FSA programs allowed us to work through some long-term issues with customers that wouldn't have been able to stay with our bank had we not been able to either shift some of their loan portfolio to FSA, get it restructured at a lower interest rate, either put a guarantee on it, whatever the situation might have been. Regulatory agencies in the banking industry have a very good purpose, but sometimes the regulators come out and they are a little bit, they get focused on something and they get just a little bit harder to deal with than what most bankers would like to have sometimes. And if we had, in the 80s, when we would put an FSA guarantee on a loan, well, they'd kind of pass on by it and say, well, you got this guarantee, if it doesn't work, well, you'll be fine, you know. And so FSA has played a real vital role all along through the last 25, 30 years. And a lot of the times when we would go to FSA, they do use their own programs, but our bank is a preferred lender through FSA. We're able to take the farm analyst information and use it to get an FSA guarantee. In fact, sometimes FSA will actually pick up that information and then they transfer it over onto their own forms and so forth and utilize that within their office. But it's been very beneficial for us because, again, it allowed, there's a certain amount of paperwork. Sometimes we get hung up in not wanting to put that stuff together because of all of the paperwork that goes with it. Dwayne saved my hide a lot of times in coming in and doing the cash flows, the financial statements, the things that FSA needed that I didn't have time to do. And I guess that makes me think of another point as I'm saying that ag lenders across the state today are getting probably, I don't want to say, there's not as many of them, I don't know if I want to use that terminology, but what we're seeing is every ag lender has a lot larger portfolio. Now, part of that's due in part to the fact that the farmers are actually borrowing more money. But a lot of it also goes to the fact that nowadays banks need to run more efficient, just like other businesses. And so where we might have been handling in a small rural community bank, it was not uncommon, and I think there's still rural community banks out there that are having, you know, $5, $10 million ag portfolios and having one officer that would handle that. Our bank, you know, I'm handling $40 and $50 million portfolio myself, and I mean that's what we need to see happen in these banks to make them run efficiently. And so what happens is there's some of this paperwork stuff tends to start to fall through the cracks. And the Farm Analyst Program has actually allowed me in my bank to make that efficiency or get to that point. Because when Dwayne or one of the other analysts would meet with one of my clientele, they would put together the financial statement, the cash flow information, and all of that stuff, and bring that to the bank. I'd look through it, or one of my other lenders would, in one of the other locations, would be able to look through that, and we didn't have to spend the time doing it. Now, that's not to say that banks want to move all of that stuff to the Farm Analyst Program, because that's not what the Farm Analyst Program is about. But again, it's been very beneficial in that respect as well. So, you know, again, like I said, the Farm Analyst Program has been very good from the FSA standpoint, helping couple banks and FSA together through guaranteed loans, and moving some of them to direct loans. So
Questions for Jim?
I have a question for you. You said that you don't feel like it's going to be as bad in the 90s. Do you think it's not going to be as bad as commodity prices are going to be as bad, or negative net farm income is going to be as high, or what are you basing that assumption on? I know you have a crystal ball.
probably just a gut feeling. I don't know if that's not a very good answer, but you know, we probably won't see the interest rates were a big factor in the late 80s and going into the 90s. And when we seen customers that were maxed out on debt and we seen interest rates, I had loans that were at 18% interest. Now, a lot of you in this room are probably too young to remember 18% interest rates. But when you took a customer that was about stretched to their limit and their interest rates ratcheted up to 11 or 18%, well, that was kind of the straw that broke the camel's back. Again, I'm not an economist. I don't know where interest rates are going to go, but I can pretty much assure you that in the next 5 years, we're not going to see 18% interest rates. So that in itself is going to probably soften some of what we are seeing in lower commodity prices for the farm situation. The farmers are carrying more debt than they were back then, but proportionally it's probably is about the same. I mean, when you start looking at, well, you know, I guess the return that we're getting maybe is a little better than it was back then, and so, but we've got a little more debt. I just don't see it being as bad as the 80s, but we're going to have some issues. There's no question about that. And part of that comes from, and as you go out in the field and start meeting with clients, part of what we're going to see is not because things aren't workable, but because we've come off of such a, I don't know what word to use here, you know, the last 5 to 6 years in agriculture, up through 2013, like I said, it was you could kind of make quite a few mistakes and things worked okay. You know, now that we're back at $3 corn, $4 wheat, you know, in the cattle industry, and I don't know where that's going. But I mean, we've seen the feeder market come off dramatically. You know, these things are going to change. You know, the bottom line for these farmers dramatically, and if they've been used to going to the implement dealership and trading tractors every year, it's hard to get out of that habit. That habit's probably not as tough to break, though, is the habit of how much they spend every day for living. I can tell you, and that will be one of the biggest challenges that you face when you start meeting with these clients is living expenses. Farmers have gotten used to a higher standard of living than what they were used to back in the 70s and the 80s. And to change someone's standard of living and say, you know, at the end of the day, we've only got $40,000 to live off of, and they've been able to live, you know, at a level that was much higher than that in 2010, 11, 12. That's very difficult to bring that back into lump. And so that will be a definite challenge for, you know, it's already a challenge for me. I'm running into that on a daily basis. I met with a client the other day. Him and his wife, and Dwayne actually had called on this client back when he was struggling once before. I had Dwayne come up. They agreed to meet with Dwayne, and I think Dwayne met with him for a couple of years, and Dwayne would have been happy to continue to meet with this client. But I think that the client felt like, well, they got things kind of back under control, which I think that they did to some degree. We get into the better times and things seem to be moving along pretty well. And now this client is back in the same situation that he was in, or him and his wife were in, back when Dwayne met with him the first time. And, you know, he's not going to listen to me because I've already told him. He was already struggling last year. And so it's going to take a Dwayne or one of you to go out and meet with this client to get him convinced that he's got a problem. And when you work with a client for 20, 30 years like I have, sometimes it gets too comfortable and they just won't listen to what we have to say, and they might think that we're maybe being a little bit over the top, if that's the word to use, and it just doesn't go well. And so when we call Dwayne and say, we need an analyst out seeing John Doe, and one of you go out to meet with him and his spouse, it'll come across totally different.
John's got a question.
I was just, what are some of the triggers that you might look at, or the things that are happening that you decide to call in Dwayne?
You mean some of the triggers that we would see that would create us to want to use or call for a farm analyst?
Right.
Well, I mean, John, you know, as you look back, of course, you were in banking in the good years.
It was.
And so that probably makes it a little bit easier for me to answer that question than you. But you know, what we like to see in the banking world or the ag banking world today is we like to see that customer clear his operating line out every year. And not so much the fact that he may not have equity to fall back on, but the regulatory people expect that to happen. And if I have a customer that the examiners happen to pull 2 years in a row, and last year that customer was not able to clear out his operating line, and they come in next year and he hasn't cleared out again, they're gonna classify that loan. And when a loan gets classified on the bank's books, it starts to make things a lot more difficult because, number one, we're not able to move as freely with that customer as we would like to, and the customer starts to feel it. There starts to be tension then build up between the bank and the customer, and so that's probably the first thing. And of course, the other thing that comes into play is back in the 80s, that's when we learned to analyze tax returns. When I started in the banking business, it was pretty much, we do what I'd call barnyard loans, come in the office, type out the loan, shake their hand, say thank you, and hope that they'd pay it back. Well, that didn't work real well as we got further into the 80s and into the 90s. And we started doing a lot more analysis with these customers. The tax return, we require tax returns on our customers every year, and we go through and spread the tax returns at the end of the year or in April, whenever we get their tax returns. So we're going to spread that tax return. We're going to look and see what it showed for the previous year. If the customer is not able to service their debt with what that tax return is showing and have something left to live off of, that's going to be a trigger point. And we're starting to see more of that already. I am a little bit fearful. I've seen some of it in 2014. I had a handful of clients that we've seen that with. We came in, did some restructuring, and got their debt got restructured, maybe sent some of them, maybe set some of the debt aside, went to FSA, put it on a longer term payout, got their term payments back where they would be in line with what their tax return indicated that they could handle. I'm fearful when we start to see 2015 that there's going to be more than what we've seen in 2014. I mean, it's with the things the way that we've seen the ag economy go. And again, there's, and banks, ag lenders across the state have to take some of the blame for what's happened, because we've actually allowed people to maybe take on more debt than what we should have. Land prices have moved up dramatically. We brought young customers in that wanted to buy land. We did 50-50 loans with FSA, and some of those young folks are going to really struggle. And most of the cases where we did those, we looked at the family history and kind of looked at the support that was behind them, and that's one thing that wasn't there in the 80s. I mean, if I had a young gentleman come in, or a young lady in some instances come in and want to buy a farm for $5,000 an acre, I called my local FSA officer and I said, okay, what do you think? Can we do a 50-50 partnership here? And we sat and we talked about it and went through the paperwork. He said, yeah, it looks like we can do this, but most of the time when we've looked at those in the last couple of years, we've looked to see what is behind them. And that wasn't there in the 80s. In other words, what I'm saying, in a lot of those instances, their parents are very solid and will probably... I haven't seen over my 30-some odd years in banking very many times when the parents walked away from their children, unless their children were just totally way off base and not paying any attention to what was going on. And so in those instances when we've done that, like I said, we've looked back, and so there is more, there's more to back some of these loans up than what there used to be. Like I said, in the 80s, that was not there.
Jim, a question about the regulatory environment for lenders as compared to what it was in the 80s. I've heard that your flexibility has been severely limited, or is somewhat more limited than it was back then, to handle these cases. Are you seeing a lot more challenges in dealing with the examiners and the regulations in general, from the standpoint of trying to work out some deals with these?
So far, at least in our bank, we've not seen that. Now, we're probably more structured and expect our customers to have more structure than some banks. We've, over the years, over the last 10 years, looked at a number of banks that were up for sale. We'd go in and look at these banks. When a bank comes up for sale, if another bank wants to expand or move into a new territory, they have the opportunity to bid on the bank, obviously. And if their bid is accepted by the seller, they have a due diligence period. I will tell you that we have looked at probably a half a dozen banks in the last 10 years, and we've not bought any of them. We had the opportunity we had to bid, but we've not bought any of them, because we went in and felt like, after we looked at the loan structure, that it was going to be a problem for us. We're held to a pretty high standard in our bank, and have been for a good number of years by the regulatory people. And so we're not feeling that, but I'm sure there are banks out there that are feeling that. There's no doubt in my mind about that. Now, as compared to the 80s, whether the regulatory people are going to have less forbearance than they did in the 80s with these customers, I think that a lot of that will depend on the bank and the strength of the bank. If you've got a bank that's running with a pretty marginal capital level, they're not going to have the forbearance with that bank that they would with a bank that's running with a 14 or 15% capital level. And so I know that's not a very good answer to your question, but I don't know that there's a definitive answer to that, because there's so many variables that come into play with how the regulatory people look at that. That's a very good point that we have to, and we look at that to some degree, but we feel like we're proactive in our bank trying to work with our customers before the regulatory people come in and say, hey, that loan's a classified loan. If we've already targeted a loan saying, okay, or put it on our watch list as such before the regulators come in, that's what they want to see. That way they are already well aware that the bank is aware that there's an issue with that customer or that loan portfolio. And that has been very beneficial. Now, I can't speak for other banks, but I'm sure there's banks out there that wait until the regulators come in and say, hey, you haven't been watching this loan, it needs to be put on. And once that happens, again, the Farm Analyst Program, they're going to want to see a lot more documentation than what some of the banks have been providing. This program that Dwayne has been working with you on, I mean, it's a program that provides pretty much everything that the regulators are going to want to see as far as documentation from, now that doesn't mean that they're not going to classify the loan or at some point say, hey, we're thinking that this loan's bad enough, you need to start maybe doing something different with it, like, tell them that you need to find another bank or whatever. Most generally, when it gets to that point, though, it's very difficult for them to find another bank. Dwayne probably is aware of that I've looked at 2 or 3 clients that Dwayne has actually brought to my bank. We've taken on some of them, and actually they've turned out to be pretty solid customers. But we've looked at others that we kind of shook our head and said, I just don't think that these folks are probably going to be bankable in the future. And most banks out there are that way today. They are not going to want to take a loan that isn't bankable for, several years down the road, because they've probably already got enough problems. They don't want more. So, again, like I said, I know that didn't really answer your question, but the regulatory people, they have hot buttons when they come into banks too. One year, it might be, last year when they came to our bank, we're up in northeast Kansas, the highest priced land in the state of Kansas. And, all they could talk about was, when's this bubble going to burst? When's the price going to fall apart? Well, very difficult to answer that question. So far, we've seen valuations come down just a little bit up in our region, but still pretty strong. The reason for them asking that question was not necessarily because the customer won't cash flow or it won't work, but is what's the bank's position going to be if we made a loan on $8,000 acre ground and our standard procedure is to loan 80% of value. And so if our appraiser came in and appraised it at $8,000 an acre, well, we're loaning 80% of that. Their concern was, okay, so is this land value going to drop to $5,000 an acre and we have $6,400 or $6,800, whatever the number might be on this per acre ground, and at that point, once you are under collateralized, they make you write that loan down. And when that does happen, that does create real problems for banks. I mean, that took place in the commercial lending side of the banks when the housing, I don't use the word debacle, whatever word, in 2007, 2008 hit. A lot of the ag banks here in Kansas probably weren't affected by that too much. We happen to be a large enough lender that we had some of that oceanfront property in Arizona, literally. That you hear this country western, I don't know who sang that song, but at any rate, that was a big issue. More than likely the client could still figure out a way to make that work, pay the interest on it, make the principal payment. But if we had a piece of real estate that was a development property and it went from a $2 million value to $1 million value, They may just write it down. And so at that point, the bank starts squirming and saying, okay, we got to figure out a way how we're going to get away from this. And that is what the regulatory people were concerned in the previous exam with real estate. I think that they've had several meetings with lenders across the state. Federal Reserve has had some, I don't know what terminology we use, panels, discussions over this. We've had some banks that have sat on those panels. I think they've kind of backed away from that just a little bit, but that will come back again. And, you know, if we don't see dramatic drops in the value of the real estate, what they have, their concern will not be a concern that will create problems for the bank. I mean, it just, they make banks nervous over it, I guess. Because anytime regulators come in, bankers tend to get a little nervous, thinking, okay, what did we miss? You know, or what are they going to be after us for this time? You know, so, again, there's a lot of factors that can affect how regulators come in and look at banks. So.
Other questions?
You mentioned the stress test. I mean, okay, yeah, but carrying the operating load, but what all goes into your stress test, or what all are you looking for?
I'm going to ask you to speak up just a little bit. I was telling Dwayne, my hearing's getting bad in my old age. He says, you need one of these. And I blew a semi. I farmed a little bit on the side, and I was trying to put a fire out. I caused the fire, but I was trying to put a fire out. I was up underneath the semi, put the fire out, the tire blew out when I was up underneath the semi here this fall. Haven't heard very well since, so would you please, my wife tells me I have selective hearing. I don't think that's it anymore. But
what all goes into your stress test? You mentioned a stress test on those loans before. What all are you looking at other than carrying that operating loan year to year?
Well, you're basically wanting to know what we're looking at besides commodity prices and interest rates as far as stress testing those loans? Mm-hmm. Well, that's really, I mean, I don't mess with that. We have a senior lender that's all he does, okay? He sits with me on our loan committee, and he doesn't work with customers on a one-to-one on a daily basis. And so that's the stress test that we're running. It's a computer-generated program that he's actually put together, and he takes the customers' total borrowings, will stick it into his formula. He'll up the interest rate by 1%, see what it does to it. He'll drop the commodity prices by, it's not anything very scientific. But the examiners asked us to do stress testing because of the size of our bank a couple of years ago. And so we come up with something that has some value to us, but probably more so to keep the regulatory people happy. Because it's just one tool we use, but we have not used that stress testing for any other purpose at this point other than to say to the regulatory people, yes, we've stress tested these loans, and if we see a 20% decrease in commodity prices and a 1 or 2% increase in interest rates, 7% of our ag portfolio will have some issues, and they're fine with that. We're not using that at this point to go to that customer and say, look, we think there's an issue, because there's so many other factors out there that we need to look at with that customer. I mean, because we don't know that we're going to see a 1% increase or 2%. We don't know that we're going to see 20% commodity price decreases. I mean, and typically we hope if we're seeing some commodity prices and commodity prices, we're hoping we're going to see some things drop on the expense side as well. Now, they're not dropped. Obviously, the expense side hasn't dropped as quickly as the income side has, and that's narrowing the margin up some. And I mean, you know, I'm not telling you anything that you don't already know. But our primary focus is we use basically a spreadsheet where we put the tax returns on that spreadsheet for 5-6 years, look at them, kind of analyze the trends, same with the financial statements. If we start to see declining trends in their net worth, we start to see that tax return start to look like it's not going to give us the returns we need to service the debt. Those are the things that we actually focus on. This stress test, like I said, is something more for the regulatory side. I don't know if that really answered your question.
Well, and so then the next part of that is you have so many clients that are going to need assistance. Land hasn't dropped off a whole lot. Crops weren't going to pay for it when it was high. They sure aren't going to pay for it when it's low. So then my next, are we looking at mismanagement, looking at too much equipment? What's the next? What has caused a bigger share of the financial problems? Or what are we going to see cause more problems? Just too much land being bought, too much equipment being bought, or?
Well, all of those can add up, okay? It might not be just one thing. But when we looked at a young customer that was coming in and buying, I think that probably if you're looking at a young customer that bought some $5,000 or $6,000 an acre ground and borrowed every dollar, which they were able to do that with a 50/50 program or a startup program through FSA, still a very good program because it allowed people to get started that probably wouldn't have otherwise had the chance to do that. Now, whether they're going to be able to make it through those payments that are sitting out there, that's going to be a really tough question. Most of those young people that have done that aren't loaded down with machinery yet, okay? And so that's going to be a plus because, as I said, most of those young people that have bought ground in that higher price range have a support behind them. I mean, their father's either pretty substantial or the father's provided the equipment to do the farming and they've provided the labor. So, in that particular instance, the thing that's going to change in that loan that I'm just talking about with that young customer is going to be commodity prices. And obviously, you're going to be challenged as well as us with trying to figure out how we can skinny that operation up a little bit, so to speak, so that we still have enough at the end of the day to make the payment and have a halfway decent standard of living. And that's going to mean being more efficient with our inputs, trying to maybe do a better job on the production side, getting more bushels per acre,
Might mean selling an asset and trying to reduce debt because the asset isn't paying for itself. The sooner we move that and get into a better equity position, the better we are.
Well, this is true. I don't foresee, I don't know how to, you're thinking that there's going to be some situations where some of these folks that have bought some of this land recently that may turn around and need to put it back on the market. There's going to be some of that probably, but that may be a little bit like the 80s. That may not happen, or you may not get them to do it soon enough, even if they needed to do it, because two things. First off, I'm going to send them to FSA. I'm going to say, can we set this payment aside next year or this year? And FSA is going to say, yeah, we probably can work through that. And so human nature tends to, and maybe the Farm Animals Program can take some of that human emotion out of that, or help take some of that human emotion out of that, because the borrower as well as the lender, because I made that loan, okay? And I don't want to, it's pretty hard for me to say, God, man, I screwed up, you know? That's tough for a lender to do. And so the lender's not going to be pushing for that individual to sell that $5,000 an acre tract of ground tomorrow because it's going to kill him.
And I've got a young guy I'm working with right now that's concerned enough about, he's asking me, should I sell this land? I might take a hit on it somewhat, but is it going to keep me solvent, or is it going to pull me under and I'll never get out?
That's what you as a farm management analyst is supposed to run the numbers and tell him. You know, the answer to that question is if you've got a customer that's feeling that way and has already crossed that bridge, it might not be a bad idea for him to make that move. But that's a pretty rare situation. You're not going to see, I'd say that, and you might have a better answer to this, but I would say that that's going to be 1 out of every 10 that are going to be in that, are going to have that foresight, if that's the word to use. So,
Jim, and I totally agree with you, and I think foresight and timing is really applicable. I was at a meeting last week, and a gentleman with the Federal Reserve Bank of Kansas City spoke, and he had some interesting charts and statistics that showed from previous down cycles of the economy, we see the we see serious declines in agriculture capital assets depreciating, declining about an 18 to 24 month lag from when we see net non-farm income decline. And we don't know where this cycle is going to go and how long it's going to last, but if a lot of people's speculation is correct, and this could be somewhat a long-term price environment that we're in, then these previous trends would support an indication that we're in that spot right now where we haven't seen these substantial declines. We've seen machinery more so than land, but haven't seen substantial declines. But the timing, the opportunity for somebody to do that and come out, get out from under that debt is pretty tight.
The windows get narrower.
well, that's a very, very good point, because that lag period that's out there, Dwayne, is a real thing, because we aren't probably going to, there's going to be clients that we're going to see the 14 tax returns, which we've already seen. Some of them we haven't because they're still extended. And that's one thing, I'm going to digress just a little bit. If you're dealing with clients, and that has become a favorite of accountants anymore to extend tax returns, if you're happen to be dealing with clients, push them to try to get their accountant or whomever they're using to do their tax returns, get them done on a timely basis, because
I'll make a point for you. Be willing to loan the money to make an estimate payment in January so that it can be done by April 15th. Because what's happened is, this bullshit with the IRS has got us where we can't get all these farms done until March 1. But we've got to have people willing to make an estimate payment in January so they're due in April. That's better than getting the extension clear down to October. So I'm being a little blunt, but farmers don't want to pay that estimate.
this is true.
And because they haven't sold their grain because it's too cheap, we need help with the banker being willing to say this is part of your cash flow, part of your business. If we can get it done by April, you're better off than putting it off there till October.
And
I agree with you, that October thing's a disaster.
And that's true, and the thing of it is, some of it is farmer related, but I've seen more and more accountants it seems like they have the ability to drag their feet on it. I've got a $6 million credit. They're in the cattle business. I just got their tax returns this week for 2014. Now, I wasn't concerned because 2014 I knew was going to look pretty good for them. But if I have to wait that long for their 2015 returns, with where the cattle industry has went in the last few months, it's going to be a problem.
Well, it won't be a big deal. You just tell them I won't loan you money for cattle, and you give me your tax return. You'll have a tax return within a week.
Well, there's probably some truth to that.
You betcha.
We want to thank Jim for coming over and pitching it today. Thank you so much, Jim.